Today's topic, finance. So first, let me introduce the panelists. In the end, we have Sebastian Siemiatkovski from Klarna. Klarna creates a safer way to purchase online and understand credit risk for e-commerce consumers. Next, we have Sunil Madhu from Socure, the founder and CEO. Socure actually builds identity proofing software using social behavioral patterns, such as your social graph, to protect consumers and enterprises from identity theft and fraud. Fantastic. And then finally, we have Alexa von Tobel from Learnvest, CEO and founder based out of New York. It's the United States' largest online financial planner and allows individuals to set up financial goals and work with a planner real time to achieve them, all at a very affordable price. For me, it's definitely an honor to be here with you guys. Thank you for joining.
Same here.
Thank you.
So maybe to kick off the panel, let's talk a little bit about structural changes. You know, I grew up in San Francisco back in 1998, 99, and spent most of my life watching financial innovation. And there was a first wave of really active companies like Cake, Covestor, Mint, MyCFO, Prosper. And now it feels that fintech is a very hot topic again in 2010, 2011, 12. Maybe, Alexa, could you tell us a little bit of your thoughts and perceptions about what's changed structurally in 2012?
Sure. So I think a few things have happened. First, the consumer need and the consumer trend for really being focused on this has taken a massive step and advance forward. Think about it logically. We've gone through the worst recession in 81 years in the United States. You had so many people who went through a real structural issue that they were actually in need of advice, whether it was because they were defaulting on a loan or they lost their job as we are going through one of the worst stages of unemployment. So first, you have a major trend, which is that the consumer has a real heightened awareness that they really need help. Second, you also just have the bigger online trend, which is all of banking is going online. For even individuals 55 years and older, online banking is the norm for them. So you just have more and more people getting significantly more comfortable with managing their finances online. So I think in many ways combine that with the new technologies that are out that make it better and easier to offer fantastic products, you kind of have a major trend that's evolving.
So does that mean that people are simply frustrated with the existing banking infrastructure?
I'd say yes. I think that the existing infrastructure is slow. Its regulatory compliance and governance requirements in the fintech space is kind of acted negatively in innovation. Would you like to add something to that?
No, I totally agree. I mean, there's no better place to be as an entrepreneur when you have huge companies moving extremely slowly, making tons of money and profit, and best of all, in the last couple of years, they become extremely unpopular and everybody hates them, called the banks. I mean, it's an obvious target for startups.
And Sebastian, to that point, how are the businesses responding exactly to this changing behavior? It feels like you deal a lot with the SMBs, and what's their receptivity right now?
Well, the SMBs kind of, most of the merchants that we work with on the merchant side, they have exactly the same challenge, that they are trying to use payment services that mostly are offered to them by huge companies to some degree, even if, some gateways are maybe smaller, but the acquiring side and all of that is huge. And once again, they get no sense of truly customer-centric companies that really try to help them to be prosperous and successful in their businesses. And so it's obvious from that perspective.
But, and Alexa, just to your point about consumer behaviors, it's very tough to gain the trust of consumers. How do we do that exactly? Because building an online financial institution is very similar to building a brand like a bank.
So I think it's actually, I think that's the hardest piece of the puzzle. But I think to your point that people don't really trust the banks. In the United States, the reason why we went through such a bad recession is the fact that people were literally taking advantage of other people. Banks were giving out mortgages that people couldn't afford. Bank of America at one point turned on that they were going to charge, $10 a month for having a basic checking account. And customers just genuinely felt that anywhere they turned, they had to be on guard. And what that evolves into is just a massive feeling of distrust. And so I think that, particularly for a company like Learnvest, where it's set up as pure advice. We don't sell any financial products. And it really is like oil and water because there is no offering at the end. There's no credit card. We just offer full advice, 360 degrees without selling anything. And I think that's really important to building a brand that people can trust because it's just extremely apparent. There's no other way for us to make money. And I think that those are the sort of brands that are evolving and getting traction.
And Sunil, on the trust side, you're actually spending a huge amount of time verifying identity.
Yeah, I think trust and kind of identity go hand in hand. A lot of lending decisions, credit decisions, et cetera, are made using a myopic view of consumer spending habits. So think about it, right? You have credit scores, and credit scores aren't even universal, and they look at your spending habits from your usage of credit, but increasingly this is a debit and cash economy. What about your positive behaviors in non-credit usage? So, I think that security plays a big role. Fraud is growing faster than world trade because of the ease of availability of information right now. At Secure, we're trying to solve this serious problem.
Sorry.
I was just going to add one thing, which is another reason why trust is so important is you don't learn about personal finance in schools in America and also in other places, yet you are affected by money every single day of your life. We make about 6 to 10 money decisions every day, and those decisions are fully unguided. If you never learn about it, and the topics are extremely complicated, a mortgage is a 190-page document. How your credit score is calculated, it takes like a PhD to understand exactly how exactly they get to those numbers. Yeah. And so I think that there's also this real level of everyone knows that they're not an expert, and so that's why it's so important to be able to have someone that you can trust, because you really do need guidance.
Yeah. But also, to add to that, I think that one of the things that really did happen in 2007 and all these years is that historically it was like, yeah, if you're big and old, you can trust us, right? Because the banks were old and big, and that meant that you could trust them. And hopefully, and I think that became very apparent to everyone, it didn't mean that these companies, the large banks, were actually doing their business especially properly, or they were failing on a massive scale. And it really, I think it hopefully taught the consumers that comes back to how do you create trust? Yep. And I think that is done from our point of view. It's done through transparency, through being available. Yep. For example, most banks still have 6 to 3 p.m. or whatever open offices, Monday to Friday. All of this kind of stuff, that's not being available. That's not establishing trust. And I think that all generations, but especially the new generations, are measuring trust by availability, transparency, likability almost, in a sense, from the branding perspective. And I think that that's where the opportunity is for the growth companies.
But Alexa, does that also mean for you that it's a massive marketing endeavor as well?
I think that the opportunity is truly unlimited. When you think about the fact that what Learnvest does, which is, we're financial planning, we give people the ability to talk to someone. Right now in America, only the 1%, without being political, literally the 1% of people who have over $1 million in the country get access to trusted experts. But for the rest of people, which arguably financial planning shouldn't be a luxury, the less money you have, the more important it is to have advice. It's a massive market opportunity. And then you think things like basic common sense, right? We mirrored our support center after Apple's Genius Bar, which is we're open nights and weekends. It's not rocket science. When do you deal with your financial life? Not during working hours. And so we opened those things up, and I think the consumer's been extremely responsive to just those basic endeavors.
That's great. That's great. And let's talk a little bit to shift gears on data. So, everyone's talked about data. We're talking about patterns that connect at this conference. Maybe, Sunil, could you start? How has data reformed the scoring process? The emergence of the social graph. Can you give us some detail around this?
Sure. Traditionally, financial institutions have created scoring models which are based on user behavior patterns. They look at how you spend money using their financial products, but historically, they've not been exchanging that information around fraud and risk and usage patterns amongst their peers. So American Express, for example, doesn't necessarily know how I spend my money on my Bank of America card, which doesn't know how I spend my money on my Chase Manhattan card. So there's that aspect that there is really a lack of unification in the available data that allows us to model the consumer behavior better. I think all of us have probably gone through this problem at some point in our past. Let's say you travel somewhere and you buy your flight ticket on bank card X because you get more miles, and you land in that destination and you try to use your Amex card, say, to pay for something. The first time American Express sees you making that payment is when that transaction happens. So as a result, the existing fraud models basically have false positives. They think that your card's being used in an unauthorized way, which causes friction. You have to contact your bank and say, hey, I still have my card, and you've got to spend several hours convincing them. But looking at behavior patterns more holistically, and let's sort of back up one step and sort of say, social is really about sharing information, right? And you can use the signals that come from that social usage, the information that people share, to preempt these type of behaviors. I'm traveling somewhere, I post about it, I tweet about it, I blog about it, I post pictures when I'm traveling somewhere. That information could have preempted the fact that I was actually going to arrive at that destination, and the bank could have made a decision not to block my card. So I think that part of it is looking at the consumer user behavior model more holistically to make more intelligent decisions.
Yeah, well, I'd like to add to that as well. I Klarna, we have done so far about 50 million transactions online, all of them credit-based, and all about is understanding the data available at the time of purchase. I think that there is really something here. I know that using data and consumer trust is a very interesting mix, because if you go to Germany, for example, since we're here, if you tell a German person that from a Datenschutz perspective that you're going to use Facebook data for credit assessment, it's not the thing that people go hooray about and they become super excited. So it's really, you really need to keep like the balance between accessing the right and the right data that gives you really to be really efficient in your scoring. But it's also about making sure that people feel that you are open and transparent about what you're using and how you're using it, etc. But I know that we believe very strongly in Klarna, because that's what we're doing. We're giving people the ability to pay when they receive the goods. We ask them a minimum amount of questions like, what's your name and address, and that's all to finalize a purchase. And in order to be able to do that, the only way of doing that is really being efficient at looking at the other data that you're not unawarely giving away. What time of the day are you buying? What type of products are you buying? There's numbers of such variables, hundreds of variables that go into our scorecards. And I also think that the really interesting for me, comparing to the banking sector, is that when I talk to banks about this, they go like, how can you be crazy? How can you give people money just based on so few questions and then trust them to actually pay you eventually? And I say, well, to me, I'm in a much better spot online than you are when you're standing in one of your retail banks with somebody filling out a questionnaire, because that person can fill in whatever, and there's so much data going on in that room when that person applied for the credit card. They are sweating, maybe they change, well, my income is actually a bit higher, so I'm going to change it. There's all these things going on that you cannot record efficiently. You cannot use that data in order to assess what the credibility of this person is. While online, you can access and record this data very efficiently, and it will help you become much, much more efficient. So actually, I often say that we're in a much better spot of assessing risk online than you are in the offline world.
And that's also resonated to your default rates, which are significantly lower as well than industry averages. And Alexa, you actually gather a huge amount of data about what people are budgeting for, what people are buying, where their accounts are managed. How do you make use of this data in the most appropriate way in order to make sure that you have trust continuously?
So just to echo that, one of the pretty fascinating things about, so we have hundreds of millions of transactions running through our system. Our average user links more than 5 accounts. We see their full wallet, and to your point, If you go through and think of a Bank of America, they just know what's happening with your checking and your savings. You go to American Express, they just know what's happening on that specific card. You go to Fidelity or Vanguard, they just know what's happening with that investment account. At Learnvest, we actually not only see your entire financial wallet because you're working with the financial planner and you want them to know everything that's happening, not only with the past, the present, but also we know what they intend to do and we know where they want to go. So when we think about data, first, we see the full wallet, which is a very rare thing that happens, particularly in the United States. And so we're finding that a lot of different big companies are coming to us to say, hey, can you help us potentially approve customers that we've been turning down because you can verify that their salary is higher. And so we're trying to figure out, and as a company, we will only ever operate on the side of the consumer. That's just been our mission from day one. And so it's opening up a lot of really unique opportunities where we are going to be able to help our customers more. But also, we know pretty candidly the number one things that are keeping people up at night. For example, the number one money question right now across our now hundreds of thousands of users is, if I have an extra X, $500, $5,000, what do I do with it? What's the biggest way to maximize it across retirement, debt, student loans, mortgages, kids 529 plans? And so we're trying to come up with really smart ways to help people do that faster and easier.
And that's advice that's not readily available to many people.
Because it's specific to you. It's personalized based on what's happening in your personal graph and what your goals are.
Yeah. And Sunil, I mean, do you think consumer risk has gone down? Or are we simply just better equipped to know what the risks are?
I think consumer risk hasn't gone down. I think the risk still exists, and I think it's all about making more intelligent decisions. Part of this is really around authenticity. If you consider what's happening in the offline world today, if I physically visit a bank, I could forge ID cards, I could forge documents. So really, we talk about credentials as a mechanism of validating someone's identity. That is much harder to do when you look at the levels of interaction you have to have in order to establish social profiles. We're in fact going back in time before badges and passports and driver's licenses, back to the time when if you had to prove that you were authentic, you'd have to get the people who you've grown up with, your family, your friends who know you, to validate that you are in fact who you say you are. Today we can do the same thing with algorithms looking at social data, where we use machine learning to say that this particular user is authentic. So, I think that these consumer risks exist, but because of the availability of information, opt-in capabilities, etc., for consumers, we can make more intelligent decisions around, managing that risk.
But let's talk about something that you guys touched on a little bit, which is the privacy aspect of things. Should individuals be able to have a clear separation between what they do tonight at the DLD party and not have that affect their ability to get a mortgage?
Absolutely. I mean, see, when you think about social privacy, I think that's a misnomer, right? Because what is social if it's not about sharing information freely? But so far, we've been conditioned to think about the financial part, financial profiles, etc., as a distinct thing from social. I think really this is a simple matter to fix by, first of all, recognizing that consumers own the data that they actually contribute into these networks, and then empowering them to control how that information is used. So at Socure, for example, we are very, very careful not to just sit there and mine information about consumers without their consent. We use opt-in as a capability to go to the consumer, inform them, educate them through the financial institution, and then use their data with their permission. So I think that that's very important. And the other thing is the dichotomy of privacy rules in different countries. Europe prides itself in terms of being pushing the envelope in terms of privacy, right? So I can't ask you for your mother's maiden name, for example, to help you reset your password here. You can do that in the US. But at the same time, you've got cameras monitoring people everywhere. So there's this dichotomy of what privacy actually means in different countries and geographies, and that'll change over time.
And Sebastian, I mean, you assess credit scores for individuals. You take on credit risk. I mean, how much do you leverage social data, and what is your general take on its applicability thus far?
Right. So we are using it to some extent, but actually, so far, all the testing that we've done, and it's based on opt-in and make sure that we follow the regulatory framework, it's not very strong indicators so far for credit. It is, however, a strong indicator for identity and fraud aspects of it. So that has been, as far as we've come, at least, on that type of research. But I think that what we've done as well is, and I think it comes back to your question about the consumers and what do the consumers take. I think that it's probably going to be more on the side like, well, to the customers that you would normally say no to, if you share this data, we might potentially say yes, for whatever type of financial business we're talking about. And then you basically ask the consumers, oh, you're fine with sharing this, there is a potential upside to sharing it, right? And I think that that's what both you have commented on, but I think it's probably the direction where it's going to go. And then again, also on the other hand, there's going to be a shift towards people sharing and being more comfortable with the fact that there is just more data out there. I mean, it's funny, in Sweden, where I'm from, where we have privacy issues as well, actually anybody can call to the tax authority and ask, how much money did I make last year? And how much taxes did I pay? And you can also, there's a national database for all telephone numbers. So you can just basically, check whomever. And people get used to these stuff. Sure. And still they fight over privacy issues on other things, but they're totally fine with anybody being able to give a phone call and ask what your salary is. So I think that these are cultural aspects, but I think over time, and especially if you look at the new generations growing into Facebook, etc., it's just so natural to them that my data is shared. Yeah, there's nothing I can do about it. That's how it's going to look. So there is that shift. But of course, for us as a firm, we need to be very careful, making sure that the consumers we're transparent against them and they understand how we're using the data and that we are within the regulatory frameworks.
But that's interesting because then this is inherently one of the structural shifts. People are just more comfortable sharing more about themselves naturally. Absolutely. And then being okay and understanding that it's being used.
Just a few data points on that. So a lot of the large dating sites in America added credit score as one of the fields, which was a really interesting shift. But then you think about things like the Jawbone and the Fitbit, where literally you can find out how many steps I took or whether or not I slept properly last night. So just in general, we are going through and will be going through an ever persistent data trend. But I think what's really powerful is getting that data to the customer and then helping them understand what that data about them means, right? If you're just going to dump on them a bunch of data about their financial life, but they don't consume it and can't understand it. And I think that's what we were seeing for the last decade, which was, as a college senior in America on a college campus, literally at career day, you could get a piece of pizza and a credit card and not understand how to use that credit card. And we've all been shopping before where they offer you 15% off to open a line of credit, and you never understood that that's actually the worst credit card that you can get. Those are the types of things we want to avoid.
But if I can add to that as well, I think actually that is a big trend that we're seeing in general when it comes to data, is the fact that if you look at like Google Analytics, you look at Mint.com, which was an early site in the US, it was about exposing and showing these nice diagrams about your economy or whatever you're doing. And you look at that and you're like, oh, this is cool. And then what I do now, right? I mean, where the shift is, what's really interesting, and we're seeing the same, how we can use our data. Like, we have a lot of data we can help our merchants grow their sales even more, but they're not interested in just us exposing that and giving them a statistics portal. Anybody can do that. Yeah. What's interesting is, how can we leverage that data and tell them, you know what, if you would do more of this is what's going to happen. It's exactly the same trend that we see in these things, that it's about decision support. Basically what we're talking about.
That's exactly right. Sorry. That's exactly right. I mean, basically giving information back to the consumer to help them adopt positive behaviors like they've been taught to do in the world of credit. I think that's an important part of this puzzle.
And I was just going to add that that's exactly why we took the tool and added a team of certified financial planners across the country to be able to allow people to understand what the heck does this data mean and what should I do and how do I change my behavior so that I have more money and I'm in a better financial position.
So all of you guys have massive technology and data mining departments to really go through because there's so many data points that we have. Well, so I'm going to to pivot again to a different topic, and one of you mentioned this dirty word just recently, regulation. Is regulation helpful or not? I just keep it general. I'd love all three of your guys' perspective on this.
My quick perspective is, so Learnvest is a registered investment advisor in the United States. We're registered with the SEC as we give investment advice. And for us, we think of regulation as something that's been really a friend to our customer, meaning in order to be regulated, we have to go through, we have a chief compliance officer, I have 2 ops people, we have an entire system that we have to go through in terms of getting our financial planners to be picked properly, we record calls, and so every customer can be comforted that they're going to get an incredible level of service and quality because we have to provide it to them.
That's a trust symbol though, right?
That's exactly right. It's a trust symbol.
So in the US, we have SOX, GLBA, Dodd-Frank, PCI DSS, FFIEC, blah, 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 blah. Has it prevented any of these banks from failing? No, they're too big to fail. So I think regulation can be both good and bad. Unfortunately, a lot of politicians put into law regulations that put governance and compliance pressures on companies without being fully informed about the consequences of those laws. And over-regulation can be stifling to innovation. So I think finding the right balance is key.
Right. Yeah, so Klarna is a regulated entity. We have basically a bank license. So we can accept deposits that are insured by the government, etc. That's actually how we finance our business. We're about 800 people, which of probably 30 work with compliance and regulatory aspects of it, to some more or less. And I think that, to me at least, I find this so extremely interesting because to be extremely successful in the finance industry and to really tackle on the banks, it's not only going to be about tech innovation. It's going to be about legal innovation to some degree. And that's always a risky thing when you say that, because people go like, oh, you're going to break the law, what are you talking about? No, what I'm talking about is that when you come with new solutions on the market, you need to look at what are the legal requirements and how do you find a balance between making sure that the legislator, the government, is happy, but at the same time, you provide something that is extremely simple to use and user-friendly for the consumer. And that is a balance that is actually extremely hard to achieve and requires you to have both fantastic engineers as well as fantastic legal people and fantastic finance people. And I think that that's really what makes it so hard. To me, when I look at the internet banks, most of them are such poor implementations from a user-friendliness aspect. It's not to me that it's the tech guys in all the banks who are stupid, sorry to use that strong word, but it is really the fact that the legal people are saying they think that their work is to say no. Like a tech guy would come with a new idea and the legal guys go no. Because that's my compliance, say no. Because you don't want to take any risk whatsoever. And that's just not, I mean, that's not the way to be innovative and to be successful within the finance industry. So it's about finding that balance. But of course, within the legal framework that is out there.
But that's inherently a risk for businesses trying to really grow and expand, right? How do you overcome this? Is it really just having strong compliance departments? Is it really ensuring that a top-down approach, you focus on both technology and compliance? How do you get over this, Alexa? It's so important, especially in yours.
I was just going to say, I feel like I couldn't agree with you more. We should probably get drinks after and talk about it for like 5 hours. No, but I think what's pretty powerful is that in many ways, the regulatory environment is going to have to catch up. So as much as it's on us to consistently juggle what our compliance officers are saying, but at the same time, what's going to happen is the innovation is happening so rapidly and so quickly. And the fact that you're no longer having a face-to-face meeting with someone, but you can have a phone call with someone, what does that mean? And it's consistently happening so quickly that they're just going to have to catch up.
I think part of it is also lobbying. I mean, if you recognize that the industry you're actually going to try and do some innovation in is going to be stifled because some government is going to pass a law that's going to prevent that innovation, then it behooves you to move them and educate them so that the regulatory pressures are reasonable.
But this is, if I can get a concrete example about this, because it's an excellent point. I think that one of the things, European consumer credit laws has changed quite recently, and there's been updates in all countries, etc. And this is really where the regulatory aspect comes in. It's so obvious to us, because one of the things that happen is, for example, that in some geographies, they are requiring you to make sure that you have the income level of the people applying for credit. Which in our case, since people are buying something on an invoice or Rechnung or whatever for 100 euros, we're talking, is not really relevant always. And the interesting thing, however, is that the regulators come and say, you have to look at income, which is stupid, actually, because we can show that there's other data points that have a higher explanatory power for losses than that, but we're still forced to do something that actually will make us take worse decisions. And this is something where we get extremely frustrated because we're like, well, we would like to use this data instead, which is freely available and that will allow us to be better and actually make sure that nobody gets credit who's not supposed to get credit. And so this is actually exactly such
Excellent
a point.
Yeah.
One just last thing to add, which is the regulatory environment in many ways, once you get to a size like yours, 800 people, or like Learnvest, it actually provides you a little bit of competitive advantage because no smart, bright entrepreneur can just pick up one day and all of a sudden have a company. You need capital in order to be able to compete in a regulatory environment, and that capital provides some insulation if you already have it. So that's the pro. The con is that you're not going to see as much innovation, which is why, you know, there's only one even semi-competitor to Learnvest, because it's really hard. So it's why it's so important that entrepreneurs like us keep doing what we're doing, because we're really fighting on the side of the consumer. And I hope that the regulatory environment relaxes a bit.
That's a great point. And so does that mean that on the positive aspect for regulation, it makes it a barrier to entry for others to compete? But on the risk side, does that mean that regulatory reasons barring, it's more challenging to expand geographies? Does that mean that inherently your business and your business, which are US focused, it becomes a lot more challenging to go outside?
Absolutely. I think that, as I pointed out earlier, there isn't any consistent view on how to manage, for example, lending worldwide. And that's changing. In the US, we have companies like Lendo, and that's doing peer lending based on the Grameen model. So I mean, I think at the end of the day, sort of pushing the envelope with innovation, getting the buy-in from regulatory compliance leaders in politics, et cetera. These are all key things for us to be able to innovate and create new models for how credit and scoring can help consumers.
And I think the union here actually has done great because in many aspects today it's easier to expand this business within the European Union than it is between the States and the US, especially on the business side. On the consumer side there's still local variances, but actually it's pretty simple in the EU to launch. It's getting very much harmonized, the regulatory aspect of it.
Great. So I think given time constraints, I'm going to ask you one last question and then we'll open up to questions from the audience. So if you guys could summarize for me, looking back at where you are today, I'd love to hear in a succinct one sentence, where do you guys envision yourselves 5 years from now? I mean, Sebastian, maybe we start with you. From 2005, 3 guys on a beach, to now joining the $1 billion club. Maybe you kick it off. Where do you think you are 5 years from now?
Ooh.
Still on the beach?
Yeah.
Back on the beach.
Back on the beach. No, I would say that, I mean, hopefully Klarna is really a global player in the payments market, enable people all over the world to really trade and transact safe, simple, and fun in a good way. I think that's what we're trying to do.
Great. Sunil?
I think 5 years from now, Secure will enable ordinary everyday consumers to get credit decisions made very easily, to be able to be safeguarded against identity theft and fraud, and to reduce fraud losses overall for financial institutions, merchants, and consumers.
In 5 years, Learnvest should have about 5 million customers, and we'll have made getting financial advice and planning as easy as a gym membership. So for a small fee every month, you have access to your same trusted expert via phone and email, and we provide you unlimited advice. And it's the way it should be. Financial planning shouldn't be a luxury.
And if it's just like my gym membership, they never let me leave.
That's what we're going for.
Perfect. Well, look, we have a few minutes if there's any questions from the audience. Okay, perfect. Well, look, thank you guys so much for doing this.
Alan.
Very quickly,
Of course.
this new concept that for dating, people are checking credit scores. I'm just curious what your reaction. I don't know if any of you run into it.
I just did an interview with the New York Times on this, and I said my honest thought, which was, I'm a romantic, so I wouldn't necessarily choose my significant other based on their credit score ever. But what you are seeing is people are significantly more aware that when you get married, and since divorce is at an all-time high, people are seeing that their finances do get combined, and it is important to have a real understanding of financially what's happening with your significant other, which as of a decade ago, people weren't probably even aware of until they were actually getting married. So I think there's just heightened awareness everywhere, and people want to avoid financial struggles as much as they can. So it's becoming now a topic, which is why it got added to the dating sites.
So Alan, I've got an interesting point, right? If you're going to date somebody, you tend to Google them, right? To make sure they're not an axe murderer. So really, at the end of the day...
That's on Google, isn't it?
It's on Google.
There's a little attribute for that. So really, at the end of the day, I think credit scores aside, it's really about figuring out if the person you're dealing with is authentic. We've seen in the news in the US recently the issue of someone dating somebody online who ended up being a non-person, right? This risk is clear, it is growing, and finding out that people are authentic and trustworthy is the key concern there.
Yeah, and I think, I'm coming from a country where that has been the tradition for many, many years. There's something called the Taxation Calendar that people used to buy, and it allowed you to look up all your neighbors and see exactly how much they were making. The interesting thing, though, was a couple of years back, they took this book and they published it online, so you could access it online, and it was a huge privacy issue, and now it's been banned. So now you can only buy it in the old booklet format to check your neighbors. So to me, it's
That's far more secure.
It's not something new.
Far more secure.
Yeah, far more secure.